All right, let's get started. First off, welcome everyone and thank you for being here. My name is Garati Joseph. I'm a Florida real estate instructor with over 10 years of real hands on experience in this business, helping buyers, sellers, and investors navigate real estate the right way. But today we're not talking about deals, we're talking about something that stops a lot of people from passing the exam. And I'm talking about the real estate exam. And that's the real estate math portion of the exam. Now, let me tell you this up front, math is not hard, it's just how it's taught. So today I'm going to simplify that for you. We're going to break down some of the key formulas you're going to need, how to approach questions step by step, and common mistakes students make and how to avoid them. And I'll also walk you through a couple of real exam style questions so you can see how to solve them. And by the end of this session, my goal is to simply help you feel more confident, have you stop overthinking, and so you can start seeing math as something you can actually master. Because remember this, most people don't fail the exam because of math, they fail because of the process. So today we can fix that. So let's go ahead and jump in to the next slide. All right, this is where everything starts to click. Most people struggle with math on the exam not because it's hard, but because they don't recognize the type of question. My goal is simple: train you to identify the questions within seconds so you already know what to do. You're not guessing, you're not taking shortcuts, and you're also following a step by step system every time. I'll also show you why the formula works so you don't forget it under pressure. And here's the advantage: you'll learn to eliminate wrong questions or answers quickly even before finishing the math. We're focused on only the most tested formulas so everything becomes familiar. By the end of this, math won't feel stressful, it will feel predictable because you're not solving problems, you're following a system. Let's talk about why math actually matters on the exam. Math makes up about 10 to 15% of the test. And here's the good news: these are some of the most predictable questions you'll see. If you learn the process, this becomes the easiest points to pick up. Now, most students think that they're bad at math, but that's not the real issue. They lose points because they rush, they get confused, or skip steps. The exam is not testing how smart you are in math, it's testing whether you can follow a method. And once you understand that, everything changes because now you're going to stop guessing and start actually taking your time to understand what the question is asking. And that's the key. You don't need to be good at math. You just need a simple system you can repeat every single time. Now, let me show you how we're actually going to break this down. We're not just going to look at random questions. We're going to deconstruct the most testable patterns on this exam. Because once you recognize the pattern, the question is no longer hard, it's predictable. So when you see a question on the actual test day, you're not thinking, what do I do? You're thinking, I've seen this before. Now, here's the difference. A lot of people try to pass this exam by memorizing everything. That doesn't work under pressure. What we're building is a repeatable method, something you can rely on every single time because on exam day, you don't need to remember everything. You just need to follow your system. And once you have that system, your confidence goes up and your speeds improve and your accuracy increases. This is how you pass the exam the correct way. Okay, so before we jump into this example, here's what you want to think through this type of question. Start with the purchase price. This gives you the base of the transaction. Then check the existing mortgage to see how it affects the structure of the deal. Next, focus on the new mortgage because this is where the intangible tax comes from. From there, apply your documentary stamps to the correct amount, making sure you know what's being taxed. And remember, intangible tax is based on the loan, not the full purchase price. Finally, you're going to combine everything to get your total tax due. Now let's actually walk through a real world example step by step. All right, let's go ahead and jump into our first official problem. We're going to take our time and read the problem. A buyer is purchasing a property located in Pinellas County. This transaction includes the following: a purchase price of $67,550, earnest money deposit of $4,000, record the first mortgage assumed at $27,800, a second mortgage new at $14,700, and cash at closing $21,050. The question is asking, what is the total amount of the documentary stamp tax and intangible taxes due on this transaction? Yeah. So it's very key and crucial to take time to actually read the question. Now let's slow it down and identify what actually matters. The purchase price is listed, the earnest money is listed, the cash at closing is listed. But for this question, those numbers are mainly there to distract you. What really matters are the mortgage amounts because this question is asking about taxes tied to financing. We have an existing assumed mortgage of 27,800, a new mortgage of 14,700. Remember that because that's what we need to know. Now we're going to actually go through our steps. Step number 1 is existing mortgage. For the assumed mortgage, we calculate documentary stamp taxes. So we take the assumed mortgage amount of 27,800 divided by 100 times 0.35. Now let's talk about why. We divide by 100 because the tax rate is charged per $100 of value, not per $1. So first we ask, how many times does $100 units are in 27,800? That is 27,800 divided by 100 is 278. Now we multiply by 0.35 because that's the documentary stamp tax rate here. 35 cents per 100 and 35 cents written as a decimal is 0.35. So 278 times 0.35, it gives you $97.30, which is your documentary tax for the assumed mortgage. That's step 1. Step 2 is the new mortgage. Now we move to the new mortgage of 14,700. This one has 2 taxes. You have your documentary stamp tax and you have your intangible tax. The documentary stamps on new mortgage, we use the same structure, 14,700 divided by 100 times 0.35. Again, we divide by 100 because the tax is charged by $100. 14,700 divided by 100 is 147. Then we multiply by 0.35 because that's 35 cents per 100. And that gives us $51.45 for the new mortgage doc stamps. Perfect. Now for the intangible tax on the new mortgage, what do we do now? We now calculate it by dividing 100 into 14,700 times 0.20. Same reason we divide by 100 because this tax is also charged per $100. So that gives us $147. Now we multiply by 0.20 because the intangible tax rate is 20 cents per $100 and 20 cents as a decimal is 0.20. So 147 times 0.20 gives us $29.40 for the tangible tax for the new mortgage. Now, step 3, what do we need to do? We need to add everything together. We add all the taxes, the existing mortgage doc stamps of $97.30, the new mortgage doc stamps of $51.45, and the new mortgage intangible tax of $29.40 gives us a total of $178.15, which leads us to our correct answer being B, $178.15. So big teaching takeaways regarding this particular problem is the key understanding that these taxes are charged per $100. That's why we divide by 100 first. Then we multiply it by the tax rate. Documentary stamps are 0.35 and intangible tax is 0.20. So on exam day, don't just memorize the formula. Remember what it means. Divide by 100 how many 100 units are in the loan. Multiply by 0.35 or 35 cents per $100 for doc stamps. Multiply by 0.20, which is 20 cents per 100 for intangible tax. This makes the process much easier to understand. Now let's talk about depreciation. Keep this simple. When you see this type of question, always focus on the building value only, not the land. Next, look at the useful life, which is how long the property is expected to last, and the effective age, which reflects the condition, not the actual age. Then we apply the age life method, which is just comparing how much of that life has already been used. From there, we calculate how much value has been lost and subtract it from the original building value. This gives you the depreciated value. Now let's apply this step by step to a real problem. All right, so we got ourselves a depreciation question right here. Let's go ahead and read this together. A building is valued at $135,000 with an estimated useful life of 25 years. An effective age of 5 years. The question is asking, using the age life method, which is the depreciated value of the building, or I mean, what is the depreciated value of the building? Now let's break this down step by step. First, remember this. We are only dealing with the building value, not the land. All right, so step one, find the depreciation percentage. We will be using the age life formula, which is effective age divided by useful. So the effective age is 5 divided by useful life is 25. So 5 divided by 25 is 20%. This means the building has already used up to 20% of its value. Now, step number two, find the dollar amount of the depreciation. Now, apply this percentage to the value. $135,000 is the value of the property times the depreciation at loss is $27,000. This is how much value has been lost, $27,000. Now, step number three, find the remaining value. Now, subtract the depreciation from 135,000, which gives you $108,000. So your final answer is letter D, $108,000, which will be the actual depreciated value of the building. Now, key teaching points. Think of this way. The building has used 20% of its life, so it has 80% of its value left. You're simply removing the used portion to find what remains in this particular problem. Let's talk about gross income multiplier. Keep this simple. Start with the annual gross income. That's your total income before any expenses. Then look at the sales price because that's what you're comparing the income to. The formula is straightforward. Price divided by gross income. This tells you how many years of income it would take to equal the full value amount of the property. So when you interpret this, the lower the gross income multiplier usually means a stronger return, while a higher one means the property is more expensive for the income that is producing. Now let's apply this to a real world example. All right, so let's go ahead and read this together. A small commercial property has an annual gross income of $95,500 and recently sold for $620,750,000. The question is asking, what is the gross income multiplier for this property? Now, what we're going to do is break it down. First, identify your two key numbers, the sales price and the gross income. That's all you need for this problem right here. Next, we need a formula. So we're going to go ahead and follow our steps by using the formula. The formula for its gross income multiplier is the sales price divided by the gross income. So we will go ahead and plug in our numbers. 620,750 divided by 95,500. Now when we do that actual math, our gross multiplied income number value comes out to be 6.50. Now is about understanding that result. This means the property sold for 6.5 times its annual income. Final answer is B, 6.50. Now let's talk about where most people lose points. It's not about what you think. It's usually not the math, it's the process. A lot of students use the wrong numbers, mixing up gross and net. Others skip steps, trying to go too fast. Some don't read the questions carefully, or they solve the problem but don't ask what the question's really asking. And a big one is they don't double check their answers to make sure it makes sense. Most mistakes come from rushing and simple errors, not the difficulty. And so here's the takeaway. Slow down, follow the steps, stay consistent because if your process is solid, your math will be so too. So there are key formulas you want to walk into knowing before the exam. You don't need to memorize everything, just focus on the most tested questions. LTV tells you how much of the property is financed. Loan divided by value. NOI is also by performance. Income minus expenses. GIM is simple. Price divided by gross income. When you see mills, just remember divide by $1,000 to convert it. And the land question, 1 acre always equals 43,560 square feet. If you know these formulas and understand how to apply them, the math becomes predictable, faster to solve, and easier points on the exam. Focus on these, practice the process, and you'll be in a strong position on test day. If you're serious about passing the exam and getting a license, which I know you are, don't try to figure this out on your own. There's a free study guide that can get you started, and you can download it directly from the Urban Real Estate School Facebook page. And when you're ready to take it to the next level, well, there's actually a class that's being held live in person April the 14th at Urban Real Estate School, which gives you real world guidance, structure, approach, and proven strategies to help you pass your real estate exam. If you have any questions, feel free to email info@urbanreschool.com or give a call at 954-371-4021. Don't just study, prepare the right way and pass with confidence. I appreciate your time.